If you want to work in institutional fixed income, there is one concept you will encounter in almost every conversation about corporate bonds: the credit spread. Portfolio managers talk about it, credit analysts monitor it, risk managers set limits around it, and if you want to understand how institutional investors evaluate and price corporate bonds, understanding credit spreads is essential. In this video, I am going to explain what a credit spread is, why it exists, and how institutional investors use it in practice. Let's start with the basic definition. A credit spread is the difference in yield between a corporate bond and a government bond of the same maturity. Government bonds are considered risk-free, or as close to risk-free as financial markets get. A government that issues debt in its own currency can always print money to repay it. The yield on a government bond is therefore the baseline, the minimum return an investor requires for lending money with essentially no credit risk. A corporate bond is different. Companies can go bankrupt, their revenues can fall, their management can make poor decisions. There is a real possibility, however small for a high-quality investment-grade company, that the bond will not be repaid in full. Investors demand compensation for accepting this additional risk. That compensation is the credit spread. It is expressed in basis points, hundredths of a percentage point. If a 10-year government bond yields 3% and a 10-year corporate bond from a high-quality company yields 3.8%, the credit spread is 80 basis points. Why do credit spreads matter so much for institutional investors? The first reason is return. Credit spreads are the primary source of additional return for institutional fixed income portfolios above the risk-free rate. A life insurer that needs to earn 3% per year to meet its guaranteed rate to policyholders can use government bonds as the core, but needs credit spread pickup to generate the additional return required. On a portfolio of 10 billion euros, 80 basis points of additional yield from credit spreads generates 80 million euros of additional annual income. That is a significant number for any institution. The second reason is risk measurement. Credit spreads tell you how the market is pricing the risk of a specific issuer at a specific point in time. When credit spreads widen, increase, it means the market perceives more risk. The issuer may be facing financial difficulties, the economic environment may be deteriorating, or market sentiment may have turned negative. When credit spreads tighten, decrease, it means the market perceives less risk. The issuer's financial position may have improved, or risk appetite in the market may have increased. For institutional credit analysts, monitoring spread movements is a daily task. A sudden widening of spreads on a specific issuer is an early warning signal. Something may be changing in the credit story that requires investigation. The third reason is relative value. Credit spreads allow institutional investors to compare bonds across different issuers, sectors, and maturities on a consistent basis. If two bonds have the same credit rating and the same maturity, but one offers a spread of 80 basis points and the other offers 120 basis points, the second bond offers better relative value. More compensation for the same level of risk. This relative value analysis is at the heart of active fixed income management. Finding bonds that offer more spread than their credit risk justifies, and avoiding bonds where the spread is too tight to compensate adequately for the risk, is how institutional investors generate alpha in fixed income portfolios. Now let's look at what drives credit spreads. The first driver is credit spreads. The first driver is credit quality. Higher quality issuers, those with AAA or AA ratings, trade at tighter spreads than lower quality issuers. A BBB-rated company will always pay more than an AA-rated company for the same maturity because the market demands more compensation for the higher default risk. The second driver is maturity. Longer-dated bonds typically trade at wider spreads than shorter-dated bonds from the same issuer. The longer the maturity, the more uncertain the future, and the more compensation investors demand. The third driver is market conditions. In periods of market stress, financial crises, recessions, geopolitical shocks, credit spreads widen across the board as investors demand more compensation for risk. In periods of strong economic growth and low volatility, like 2024 and early 2025, spreads compress as risk appetite increases, and investors are willing to accept less compensation. The fourth driver is sector and issuer-specific factors. A company that reports weaker than expected earnings, faces regulatory action, or operates in a sector under stress will see its spreads widen relative to peers. A company that improves its balance sheet, reduces debt, or benefits from a positive industry trend will see spreads tighten. For institutional investors, credit spreads are not just a number on a screen, they are the language of fixed income risk and return. When a portfolio manager says, "We added a position in a BBB-rated utility at 150 basis points over government bonds," they are communicating the entire risk-return profile of that investment in a single number. When a credit analyst says, "Spreads on European bank bonds have widened by 30 basis points this week," they are flagging a potential change in the credit environment that every portfolio manager needs to be aware of. Mastering credit spreads, understanding what drives them, how to use them for relative value, and how to monitor them as a risk signal, is one of the most important skills you can develop in institutional fixed income. If you want to go deeper, how credit analysis works, how to read a bond prospectus, and how Bloomberg is used to analyze credit spreads in real institutional portfolios, subscribe to this channel. And if you want a structured learning path, check the link in the description.